Okay, well, we'll go ahead and get started. Hopefully everybody has the handout. Just to let you know, we're not talking taxes, so don't be alarmed by having a tax return sitting in front of you. I do an exercise with undergraduates and master students up at the Rawls College of Business at Texas Tech, usually 2 or 3 times a year. And I want to kind of go through that with you. I think that will be insightful and helpful to you. My name's Kraig Kern. I'm with People's Bank. I'm a lender. I do commercial and consumer loans. Pretty much any kind of loan outside of agriculture loans and conventional mortgage loans. So I kind of see them all. I spent a lot of time on the underwriting side of things before I took a lending position. So a lot of my background and experience was on the underwriting side, financial analysis, that kind of stuff before I stepped into lending. So excited to be here with you this morning. I can't tell you how cool, humbling it is to be kind of on this side of things now. I landed in banking in 2009 when I graduated from Texas Tech, and I just can't tell you how thankful I am for the relationships that the banking industry has afforded me and just the value that it's added to my life personally. I came from somewhat of a financially illiterate family, not real smart with money, not savvy on anything finance, and so the value that's added for me in my life has been just super beneficial. So as much as anything, I'm thankful for how it's helped me. I'm going to jump in because there's kind of a lot of information we're going to cover. I do have some pictures up here. This is my family. My wife there on the left is Haley. She's a teacher for Friendship ISD. She's a dyslexia therapist at Bennett Elementary. And then these are my kiddos. Elliot's on the left there. She's my 7-year-old, and then Grayson is our 9-year-old over on the right. And I just thought that's a fun picture. One of the many pretend play games that we play around the house, People's Bank is one of them. And so just thought that was fun. But again, thankful to be here, excited to kind of get to talk to you this morning. I want to start with, I'm going to just kind of skip over my slides here just to save some time, but just to dive in, the thing that I want to give you an idea of this morning is how many of you have borrowed money from a bank before? So a lot of us have. As you know, I think some of you, if you've been to a bank before, sometimes that can be overwhelming. Sometimes it can be really confusing to walk into a bank and ask the bank to borrow money, right? That can be kind of a confusing, complex process. There's the questions of when should I engage the bank? At what point should I go to start talking to the bank? And then there's the whole side of, well, what's the whole decision-making process for the bank entail? What does that even look like? And I just want to answer the first question by saying that the sooner that you can engage your bank and begin talking about financing your project or financing whatever your need may be, the better. At People's Bank, we pride ourselves on we're a community bank. We're one of the only locally owned community banks left in Lubbock. And we pride ourselves on really being a resource to our customers. And so the thing about that is just that we generally, when somebody walks in and talks about a project, us financing a project, they don't have all their ducks in a row, right? They don't have a perfect packet of information that we were expecting and needing. They come in at all levels of sophistication, all levels of preparation, and that's okay. So we would rather you begin a relationship, start working with us, and then we can be a resource to you and really kind of help you along the way when it comes to whatever that financing need may be. So the second thing, and that's what I want to get into today, is just to give you an idea of what the bank goes through and how we make a financing decision. So how many of you in here have ever heard of the 5 C's of credit? Anybody? Can anybody tell me what one of the 5 C's of credit is? No? Okay. The 5 C's of credit are guidelines basically for making credit decisions for a bank, and they've stood the test of time. And one of the things that I learned when I was really green in my position were the 5 C's. So the first thing is capacity, right? First C is capacity. I'm just going to pull these up for you here. 5 C's of credit. So these are the things that we try to, when you think about all the complex analysis and things that we go through to make a decision for a loan, You can really boil it down to these 5 things, just to make it a little less complex, okay? So let's talk about capacity. What is capacity and why is that important to a bank? What do you think we mean by capacity?
Ability to repay the loan.
Yeah, ability to repay the loan, right? Ability to take on whatever project it is you're coming to the bank to need some financing for. Your capacity, what we're looking for in terms of capacity is exactly what he just said. What's your ability? What's the company's capacity? Does the company have the capacity? Do you, as an individual, have the capacity to take on the debt? Okay, so that's one thing. And the thing to mention there that's really important is that for banks, if you ever come to our bank and sit in any of our meetings, you'll hear this said over and over again, that we're not asset-based lenders. Okay, we're cash flow-based lenders. All that means is that we want our primary source of repayment is always designated as the cash flow for your business, right? We want to see that your income generates enough cash on an annual basis, monthly basis to repay the loan, okay? So capacity is does your company have the ability to take on the debt? And we look to that as our primary source of repayment, okay? Capital. What is capital and why is that important to a bank, do you think?
I mean, it's a double-edged. You got capital you have to put in, but you also have enough capital to operate.
That's exactly right, okay? So anytime, if you borrowed money before, you know the bank's going to ask you for your down payment, right? We need to be able to see that you have capital to inject into your project. And just like he just said, not only that, do we want to see capital sufficient to cover your down payment? We want to see that you've got enough capital to support your business in the event that business needs more cash, okay? So number 2, and then 3, collateral. What is collateral? Why is that important to a bank? Do what? Yeah. So if it's collateral for us is a secondary source of repayment, right? Sometimes we have people come in and they are talking to us about their project and they're like, well, it's okay because if the business fails, you have the collateral, you have the asset. We don't like to hear that, okay? We're in the business of banking and making loans. Like I said, our primary source of repayment we always look to as the cash flow of your business. Collateral is a secondary source of repayment. We always want collateral in the event that something goes haywire with the business or the business fails, right, or closes shop, then we do want that secondary source of repayment. But collateral is a secondary source of repayment, not the primary source of repayment, okay? So that's just an important thing to highlight. What about character? Why is that important to a bank, and what do we mean by that?
Just your personal standing. I mean, I always felt the question of bank.
Yeah. Yeah, we care about your business, right? We want to see your business succeed. We want to see that your business has the capacity to succeed, but we also care about you as the owner. And we also need to understand who you are, what all you're involved in. And so your character matters to the bank. And what's one way you think that we assess character? If you've ever gone to a bank and borrowed money, you know that one of the first things they do is do what? They pull your credit, right? So, and that's pretty consistent across the board. The bank's going to pull your credit, and that's one way that we kind of indiscriminately assess a person's character, right? Is to look at, okay, well, loans that you've had in the past, have you taken care of business there? That's one way we can look at it without knowing who you are, knowing anything about you, and like I said, discriminating at any level. So black and white, if you come to the bank, a lot of banks now have shifted to basing a lot of their consumer loans entirely off of credit score. That's primarily what drives the rate on any consumer loan that we do is your credit. So credit's really important. Conditions, what are conditions? Why would those be important to a bank?
Talking about current market.
Yeah.
What market share you can obtain.
Yeah. Any other thoughts on conditions? Conditions are also just the the added conditions that the bank might place on the loan just to make that a sound investment for the bank. So just keep in mind, anytime a bank is looking at you to finance either your personal needs or your business, from the bank standpoint, that's an asset to the bank, okay? That's an investment for the bank. So on our end, what I'm tasked with as a lender every day is to make sound, good quality investments for the bank. And so in order to facilitate that, sometimes we have to place conditions around a loan just to make that a more just sound, prudent investment for the bank. The other thing that I just wanted to highlight, back to character real quick, is that is also, we look to character as a secondary or tertiary or basically third source of repayment, okay? And that's just important to highlight because there again, primary source of repayment, we're gonna look to the cash flow of your business. We wanna see that strong and steady. We want it to be well collateralized as a secondary source of repayment. And then we're gonna rely on you and your character, right, to come through. If all else fails, are you gonna pay the bank back? So that's really important. And all of that to come back to and say, engage the bank sooner than later, right? Let your banker get to know you. Let them build a relationship with you and see how you take care of business, see how you take care of your checking accounts. Let them be a resource to you. So we would much rather do that and kind of help guide you through the process of growing your business than to come in at any on the back end or, one thing we do a lot of startup businesses. And so one of the things that's always kind of painful is somebody comes in and they've done a ton of legwork and study for their business and they think they're ready to go, but this is their first time engaging the bank. And now the bank has all these needs and requirements and they're having to go back now and it feels like a major step back. That's why I say it's better if you can, even if you're in planning stages and early stages, to get an idea of what the bank's going to expect. If you do believe there is going to be a financing need, start those conversations sooner than later, okay? We're gonna shift now. What I wanna talk about is financial analysis, and I've got an exercise for us to kind of walk through and do some of that. But I wanna focus on financial analysis because when it comes to these 5 C's, which one do you think financial analysis helps us target for any of these? Capacity, right? Capacity primarily, but I also am partial to financial analysis because I think it's really the one area or level where you kind of touch all 5 of the C's, right? When you get into a deep dive of a company and someone's financials, you can assess their capacity, right? But you also can see, do they have the capital requirement? Does it, right? You can kind of get a glimpse into that. Do they have collateral that might be available? Maybe they thought they had collateral, but maybe they're not aware that there could be something else that the bank could secure the loan with. So helps you kind of determine that. Character, right? Believe it or not, when we're analyzing somebody's financials, you can tell a little bit at least about somebody's character by the way they manage their finances, right? So I am partial to financial analysis because it really kind of helps you touch at least all 5 of these. Again, the goal is we're trying to make a credit decision, right, in this process. So on this slide here, you can see if you go to a bank and your banker's going to start asking you for personal tax returns, business financials, list of all your assets. We're going to be ordering appraisals. We're going to need to know what your liabilities are. So there's a bunch of things that we're going to be asking you for. But again, the whole thing here is that when we ask you for all this stuff, what we're really trying to drill down to and make an assessment of are these 5 things right here. Okay? So what I want to do now is shift over and do this little exercise with you. Again, we're not getting into the taxes, but one thing that's really important when it comes to financing your business or your personal needs is determining your capacity. So the term that I'm sure you probably all heard it before, but banks, what we care about is cash flow. And so when we get into this, there's two things that I want you to remember, okay? Don't be overwhelmed by a tax return, okay? A tax return is just a profit and loss or a balance sheet. Okay, so just keep in mind that it's prepared for the IRS, so there's some terms and a layout here that looks complex and sophisticated, but really what it boils down to, a company's tax return, your personal tax return is just a P&L and a balance sheet. Just looks a little bit different than, say, QuickBooks or whatever your software might spit out. The other thing that's important to keep in mind is that income is not cash flow. What do we mean by that? Income's not cash flow. Cash flow is what you have left over. Is income, so these are terms that are obviously used synonymously, right? Even by bankers and in the world of finance. But income is prepared for who? Who do you prepare? When you reconcile to a company's income or your income, that's a number that's prepared for the bank. It's not prepared for the bank. Who's it prepared for? For the government, right? It's for the IRS. And so a lot of times the number that's on the tax return is driven lower, right, so that people don't have to pay as much in taxes. Well, you'll see here in just a second that cash flow and income aren't always the same. Sometimes they are, but a lot of times they're not always the same. So this is a fictitious company, okay, Southwest Theme Parks. And what we're going to do is work through this, and I'm going to show you how you can very simply kind of work through this and reconcile all the sources of cash to this company and the uses of cash to this company. And we're going to just kind of then determine what that tells us about the company, okay? So starting at line 1, there you can see over there on the left, this is the income section. So we've got income and expenses here. This is a theme park, and put yourself in my shoes for a second. If somebody, an owner of a theme park, comes to you and says, you know, hey, I'd like to, you know, we need to replace or purchase some new equipment for our theme park. Would you be interested in financing that, helping us finance that purchase of some new equipment? Okay, well, here you go. You're going to start needing some information, asking some questions. But one of the things you're going to obtain or have to provide the bank is generally a few years of your tax returns, and a personal financial statement is always a good place to start. So let's say your borrower provides you this tax return, okay, and we're going to kind of comb through this together. Southwest Theme Parks, on line 1, gross receipts or sales. Are gross receipts and sales a source of cash to a business or a use of cash to a business? What would gross receipts or sales be for a theme park? Huh?
It's just your total income.
Yeah, your total income. How does a theme park generate their sales? Where do you think most of those sales probably come from?
Tickets and concessions.
Yeah, probably general admission, tickets to the park, right? And then there's probably some concession mixed in there, probably some other attractions that may cost some money inside the park. But a lot of that's probably going to be general sales, general admission tickets sales, right? So are those sales a source of cash or a use of cash to this business? Source of cash, okay? So go ahead and put a plus sign beside that. We'll skip down to line 9, salaries and wages. When a company pays salaries and wages to its employees, is that a source of cash or a use of cash? It's a use of cash, okay? So let's put a minus sign beside that one. Guaranteed payments to partners. You'll notice this is a partnership tax return, so there's just a separate line item here for cash that's specifically paid to the partners of this company. Cash that's paid to those partners, you think that's a source of cash or a use of cash in this case? Use of cash. Okay, so put a minus sign beside that. Repairs and maintenance. Inevitably, there's always going to be some repairs and maintenance, some things to fix, right? Source of cash or use of cash? Use of cash. Y'all are doing great. This is easy stuff. Rent. So if a company pays rent to someone else, is that a source of cash or a use of cash? Use of cash. You can put a minus sign beside that. Interest. If you see interest on a company's P&L, is that a source of cash or use of cash? It's going to be a use of cash. What should that also tell you when you see interest on a company's profit and loss. Yeah. So now if somebody's come to you to borrow money, you know you have a proposed amount of debt that they're going to have the capacity to repay, right? But now we're seeing that there's interest on the P&L. That means there's likely now some additional debt that this company is going to have the capacity to repay as well, right? Okay, but interest is a use of cash, so let's put a minus sign there. Depreciation, source of cash or use of cash?
It's a source.
This is kind of a tricky one. Depreciation's generally most of the time a non-cash expense, okay? Can somebody tell me why or what is depreciation? Why does that show up on a tax return?
Deferred asset.
Okay, say that again.
Loss in value for deferred asset.
Yeah. So think about it like this. If you go out and you buy a laptop computer, okay, that's probably not going to hold value for very long, and it's really not that expensive of an asset. So a company will generally take an asset like that and just run it as an expense through the business, right? But if you go out and you buy a big piece of machinery or a building, that's a very expensive asset, and generally the useful life of that asset is longer than 1 year. So the IRS allows you to capitalize that on your balance sheet and expense it over time, okay? And that expense that you account for over time is depreciation. But we treat depreciation as a non-cash expense because the use of cash is generally when you purchase that equipment, okay? So it happens all at once. Over time, if you're just accounting for the depreciation 2, 3, 5 years later, there's no cash, there's not a transfer of cash attached to that. Does that make sense? So we treat it as a non-cash expense. Lastly, let's see, line 20, yours probably shows 300,000 in total deductions. This PDF wouldn't let me put it in the right spot. It should be in other deductions. So $300,000 of other deductions or expenses to a business. You think those are sources or uses of cash to the business? Uses of cash. Okay, so put a minus sign beside that. So when you add up all of the deductions or expenses so far in this case, that adds up to $900,000 of total deductions. Okay, so our ordinary business income is line 22. So our income is $100,000. But what's our cash flow? We've marked everything as a source or use of cash except for what? Depreciation, right? We said depreciation is non-cash. So if income is being driven down by that number, we're going to add that back. Okay, so your cash flow in this case is actually $150,000 left over. Okay, so you have a net source of cash on the P&L of $150,000, although the income that's being reported here for the IRS is $100,000. So you can see right away, income and cash flow are not the same. Okay, and the bank's going to be looking at cash flow, not for income. Let's flip over to the next page real quick. You'll see that $100,000 of income carries over. Line 12 shows section 179. That's just depreciation. Mark it out. We're not going to get into that. But line 13A, contributions of $10,000. What do you think that is? Yes. Okay, and I'm glad you know that. It's not capital contributions, okay? Capital contributions would be cash coming in, right? Sometimes owners of a business do contribute capital to their business, but line 13A in this case is charitable contributions, not capital contributions. If a company donates money to a charitable organization, is that a source of cash or a use of cash? Use of cash, okay? So now we're down to what's our net source of cash so far, once you factor that in? Do what? 140, okay? So if you stop there, this is your profit and loss, and we account for all the source. next page and go through the balance sheet. So Schedule L is just a balance sheet. There again, that's why I say tax returns, we're really just looking at profit and losses and balance sheets. We're going to go through this kind of line item by line item the same way and just account for whether it's a source of cash or a use of cash to the business, okay? So you'll see there columns A and B represent or what each line item was at the beginning of the year, and then columns C and D are what that line item was at the end of the year, okay? The change from beginning to end is going to be a source or use of cash. So we're going to skip cash for now and drop down to 2A, which is accounts receivable. So what did accounts receivable do from beginning of year to the end of the year? Increased. When accounts receivable increase, is that a source of cash or a use of cash to the business? You say source of cash. What creates a receivable? Say that again?
Credit to a vendor.
Yeah, you're extending credit to a vendor, right? So in some way you've generated, generally you've generated, your company has generated revenue, and the person that owes you now just hadn't paid you yet, right? So you book it as a receivable on the balance sheet. So does that sound like, if you're extending credit to someone else, does that sound like a source of cash or a use of cash? A use of cash. Okay. So when your receivables increase, that's actually a use of cash to your business. In this case, it increased by $20,000. So just note out to the side there, a minus $20,000 increase in receivables as a use of cash. Let's get down to inventory. Inventory, what did it do from beginning to end of year? It decreased, right? When inventory decreases, is that a source of cash or a use of cash to a company? We got use. Everybody agree with that? Source. A decrease in inventory. When inventory converts, right, that should generate cash for your business. It's actually a source of cash to the business. Okay, so note a positive 20 there. Loans to partners increased by $50,000 over the course of the year. When money is loaned from your business to the partners, is that a source of cash or a use of cash to your business? Use of cash, right? So note that one is a minus 50,000. Buildings and other depreciable assets increased by $500,000. So when a company goes out and acquires additional assets or purchases assets, source of cash or use of cash to the business? Use of cash. Okay, so note that one as a minus 500. That should be everything in the assets section. We'll skip down. There's just a couple more things on the liability side. Accounts payable, line 15, decreased from 20,000 to 0. When a company reduces its liabilities, or in this case, repays some payables, is that a source of cash or use of cash to the business? Use, right? So minus 20 there. And then it looks like in this case, over the course of the year, by the end of the year, they had borrowed $400,000. So when a company goes out and borrows money, say $400,000 in this case, is that a source of cash or use of cash to the business? Source of cash to the business, okay? And then the last thing that we just need to grab here on the balance sheet, you skip down to Schedule M2, line 6, there's those distributions of cash to the owners of the company. If a company distributes cash to the owners of the company, is that a source of use? Source or use of cash? Use of cash, okay? So who can tell me now what our net overall source or use of cash is to the company for 2020 in this case? You take the 140 that we started with from the P&L, and you add in the other sources that are coming over from the balance sheet and subtract the uses. What do we have as a net source or use of cash? Or just a wild guess? Negative what? Negative 1. Okay, so believe it or not, most business people that come into the bank, we don't have these conversations, okay? But this is a great exercise for anybody who's gonna, the more you are on top of your own financials, the better engagement, really overall, the more efficient your experience is gonna be at the bank, okay? So anyway, this is just a fun exercise, but what you should arrive at is this right here. If we take all the sources of cash and subtract all the uses of cash, you should have arrived at a net use of cash of $80,000, right? So if we're kind of quickly running through these numbers and doing this kind of exercise or math for somebody, and we arrive at $80,000 net use of cash, if we're correct, where should that manifest itself on the balance sheet? So think about it like this: for the company to have done everything, that it accomplished everything it did over the course of this year in 2020, to have made all of what they did happen on the balance sheet, it would have required them to use $80,000 of their own cash to make all that happen. So where should that manifest itself on the balance sheet? What did the cash account do on the balance sheet? Line 1. Decreased by $80,000, right? So it reconciles. It's correct. And that's just it's cool how math works, right? When everything plays out right. But a lot of that, okay, so let's go back to the decision at hand, right? The decision at hand is, would you loan this company? Say the debt that their annual payment was going to be $150,000. Would you loan them, based on what we know so far? Would you loan them the money? No. How come? I wouldn't either.
They use their money very well.
Yeah, there's more uses of cash than there are sources of cash. They don't show the capacity to take on this debt, right? But the other question is, are we done with our analysis? What else? If we stop here, we might say, sorry, no, can't do this alone. But are we? What might we be missing if we stop here?
Startup.
Yeah. 2020 was a pandemic year.
Yeah.
Right? Could have been hard on the theme park.
Future sales contracts.
Yeah. We're looking at a 2020 tax return.
Also, what is the loan going to be used for? Is it going to do something that's going to develop another
Right. Yep.
$1 million payment?
Yep. Are you just leveraging existing cash flow, or is this going to generate more sales for your company? This is a 2020 tax return, so generally we want multiple years of tax returns so we can look at year-over-year changes. All right, 2024 could look a lot different than 2020, especially 2020 being a pandemic year. The other thing, what else? But say we look at 4 years worth of tax returns for the company, and it still just it doesn't look good. Are we done with our analysis, or is there more that we need to look to? Yes. Okay. Character, right? What about the owners of the company? And the owners of the company may not add any strength, but if the company doesn't look strong, but you've got an owner that, say, just for an exaggerated example, say they're a brain surgeon for UMC, right? And they have zero debt and make $2 million a year. All of a sudden, when you factor that in, that could change the whole picture, right? So obviously that's an exaggerated example, but that's the whole process that we go through at the bank to assess capacity. And that's why the financial analysis component it's time consuming, it's technical, but it's one of the most important parts, because we're going to be able to drill down and assess a lot of those 5 C's, and overall the capacity to repay the loan. So hopefully that gives you some insight. Hopefully that's helpful. If you have any questions after this, certainly let us know. I'm going to turn it over to Kelly now so she can get into her part.
Awesome. So thank you, Craig, first of all. Thank you. I'm going to talk fast, but the way we kind of designed this is I wanted Craig as a lender to kind of give you an idea of the financial analysis, what they're looking at, the items you're going to collect, if you need financing, and then I'm going to talk about a couple of financing programs that are here locally that you might consider for your own small business either now or when you get to that point. I also just want to say, because I'll forget at the end, but, oh, sorry, I forgot. that.
Microphone.
Glad you walked back in. People's Bank has a table, a resource table right across from the banquet hall. So Craig could be there. There's other bankers there from People's Bank. They're a good local bank. They're sponsoring the lunch. So if you want to talk to a bank after this and ask some questions or more details about what Craig went over, there's bankers there at their table you can go through. So I'm with Caprock Business Finance Corporation and the South Plains Association of Governments. We put on this event today because we want to provide resources for small business owners or people thinking about starting their own small business. We have our foot in that world through the operation of a couple of different loan programs, primarily the SBA 504 program. We also have a table by the banquet hall, so you can get more information about that. But I'm going to talk really quickly about how the SBA financing works, and then a couple of programs that we have as SPAG just locally. So just real quick, we're certified to do SBA lending anywhere in the state of Texas, but we're here in Lubbock. Our entire team put this together today, so we're all here. And so we don't actively go into other markets, but if a banker or your business has other locations in Texas and you need help with financing, we'll go, but we're not actively pursuing the Houston market. This is our team. You saw them around today at some point. They'll be at the Caprock table. They were probably at registration or helping you over here in these classrooms. But this is, we're part of a larger organization, but these are the four of us that work on small business financing. So I want to talk real quick about the SBA 504 program. I have a one-pager at our table that you can stop by and get, but there's a few different reasons why you should use this or think about the SBA 504 program for your small business, and then I want to talk a little bit about what you can use. So first of all, when you walk into your bank and you've got your financials all together, one of the things that they're going to be thinking about is how much are they going to lend to you and then their lien position. Using the SBA 504 program is a great tool for you and your bank to use because it reduces the risk of your lender, basically. They get to loan you 50% of the money, but they get to keep their first lien position, which is a great place for the bank to be in. So they like that. It lowers their risk, I mentioned that. The rates for SBA 504 financing are fixed. So they're fixed for 20 or 25 years, 10 years if it's equipment, but for commercial real estate, which is primarily what 504 is used for, those rates are going to be fixed for 20 or 25 years. Our rates came out this week, they were about 5.7%. So that's insane right now, fixed for 20 or 25 years. There's also fee sensitivity. There are some fees involved with using the SBA program. They're all rolled into the financing, so your out-of-pocket expense is pretty limited. If you go talk to your lender and they say, we have loaned you so much money for this business, we are a little over-concentrated. Well, here's another option because it's going to reduce their concentration. They're going to lend you a little bit less money, but they're going to use the SBA for the rest. And then long-term fixed rate. A lot of conventional loans, just on your own for a business, are going to be a shorter term. You know, a lot of times tied to the useful life of whatever asset you're financing or using for collateral. But if you buy a building, purchase land, build a building, get some long-term equipment, those terms are going to be 20 or 25 years with the SBA. Your bank portion of the loan will be shorter, but you'll get to stretch out some of that. So here's all the things we can do with the SBA 504 program. We can buy land, we can buy an existing building. You could then renovate that building or not. That's up to you, it depends on what you need. We can help you purchase a business. Basically, we'll finance the fixed assets tied to that. So let's say you've been working for a company for 20 years, you know it inside and out, and the owner's getting ready to retire, and you're like, I really want to buy this business, I'm ready to be my own boss. You can use the 504 program to purchase, let's say, the land, building, and equipment tied to that business, and then now you've bought the business and the fixed assets, and you're able to use the 504 program. We can also, I mentioned expansion and renovation for a building. We can build a brand new building ground up. We can do long-term equipment, and then we can include all the professional fees that are involved in that, appraisals and things like that. And then there's some refinance programs. If you have a commercial loan that was for any of these things right now, we could refinance it into a 504 and help you get a fixed rate. This is kind of our common structure. So 50% of the total project cost will be financed by your lender, like People's Bank, and then 40% would be financed through the SBA, and that goes through Caprock. And then your down payment would then be 10% of the total project cost. That is also significantly reduced compared to a conventional loan. So if you're an existing business, you've been around for 2 years, 10% is your down payment for using the 504 program. If you're a new business, so you've only been around less than 2 years, it's going to go up to 15%. That's not too bad. If you are in a special use property, and what I mean by that is traditionally like a gas station, a car wash, something like that, then your injection would go up, but at worst, it would be 20%, which is still pretty low compared to just a conventional loan. So again, it's not for everything, but it is for the right type of project you might have. I'm going to skip through the timeline, but just so you know our process, if you're talking to a lender already about buying a building, you might mention, hey, do you know anything about the 504 program? I heard about it at the summit. And then they can get in contact with us and do that. You can also get our information at the table. We can go with you to your lender. If we get calls occasionally from a small business, and my first question is, who's your lender? Because we have to have a bank partner to use the SBA 504 program. So we need to talk to them as well and make sure that they're on board and going to work with all of that. A little bit about debt refinance. All of these slides will be done afterwards. Here's some loans that we did in the last year, our team. So I just want to point out, some of them are franchises, and a lot of times people don't think of franchises as being small businesses, but they are. All of our franchises are locally owned, and we can help you finance a franchise. So you've been working through one, you've been thinking about buying one, that's an option. And then you can see some of them on here are just your run-of-the-mill startup or existing mom-and-pop small businesses. This is a little bit of information. That's all SBA 504. So commercial real estate and buildings basically is what you want to think about with that. This program, we have information, our core program on the table as well. We started this program during the pandemic. It was originally for businesses that have been impacted by the pandemic. We could lend for all the same things, but primarily we were lending for working capital. Somebody talked about working capital earlier. Machinery and equipment and inventory. All of these are still eligible uses of the funds. We are no longer tying the program back to the pandemic, but your business does have to be at least 2 years old. So it's for existing businesses, but we don't have to tie it back to the pandemic anymore. That was just initially. But this is all locally through SPAG. We still like another party to participate. So if you have a lender, if you've got an owner finance on a piece of machinery, just another source basically that's not just us. These are also fixed rate. We can do these. Last core that we approved, I think, was fixed at 6.5%, and it's tied to useful life of the collateral, so that could be 10 to 20 years as well. We can, all of those counties, you can't see it in here very well, but you'll see it when you get it back. Basically, we can go all the way to the Panhandle into the Permian Basin. So most of you are from this area, South Plains, that's what we primarily cover, but we can take the core program in any of those counties that are up there. Most of our terms are 5 to 10 years. I already mentioned that, and they're fixed. And then there's a list here of the things that Craig already went over that we collect to build our loan packages. And all that information is on the flyer, and you'll get it after the fact as well. And then finally, this is our newer program. It's called the Lone Star Fund. Actually, Craig sits on our loan committee for this. So if you use him to come through Lone Star, he'll abstain. But otherwise, he's gonna get to see everything. So this is a local program that we have. It is available statewide, but again, the primary focus is this area, the South Plains. We can finance up to $250,000. I like to use that same structure typically that we use with the SBA. We just kind of copied it because it's a good structure. Your bank's going to do 50% of the loan, we're going to do 40%, and you're going to inject 10%. We do check credit on this one, and this one can be existing businesses or startup. So if you have a startup, we didn't really get into that, but the SBDC is here also, so they're a great resource if you just have an idea. Or maybe you've been kind of dabbling in a business and you're really ready to take it to the next level. They can help with business plans, projections, putting together your market analysis. They can do a lot of great work for that. We'll have a fixed interest rate on this as well, determined by our loan committee. All of the monthly payments come into SPAG. We service the loans for the life of them, so you just deal with us the entire time. You can deal working capital, inventory, machinery, equipment, land and building if you wanted to, and then business acquisition as well. So there's a lot of different uses. I think, kind of our thought process this morning is telling you exactly how to look at your own financials and giving you the perspective of a lender when you go in to have that conversation, what they're going to be looking at. And then to know that there's some tools out here. So I just very quickly covered 3 programs. There's others, but these are the big ones from the South Plains that can help your small business. The number one thing I would say too is when you go, let's say you don't even need to borrow money right now. That's fine, but you should stop and talk to some of the banks that are here today because you need a commercial banking relationship for when that time comes that you're going to need to borrow money. You should not be running your business through your personal bank account. That's a common mistake that people make, but it's intimidating to do that. So to walk into a bank and say, I don't know who I need to talk to, but I have a business, what do I do? They're here today, so you can go and find them, talk to them, figure out how to get that started. And then when the time comes and you're thinking about growth or expansion, or you've been renting and you're ready to buy your building, now you know of some of the tools that you can use to maximize that. All of these programs essentially are going to help reduce your debt burden or fix it so that you have more money for operations, which is important, and it helps you with your lenders as well. This is our team in a nutshell. We're all here. Our website is a conference website, so you'll get all of this information after the fact so that you have access to all of the slides, the recordings of the presentations, basically anything you need. But we're happy to be of help and be a resource. We're open for a couple of questions. We got a little bit behind, but we still have some time. So if anybody has any specific questions for Kraig or myself, we're happy to answer any.
You said that you do all the loan servicing just for the SPAG portion or for the bank's portion also?
No, just for the SPAG portion, that's right. At the end of every program that I just described, the SBA 504 program or either of the SPAG programs, you're going to have a loan with the bank, and you work with the bank on your payments and the rules and the terms and all of that, and you're going to have a loan with SPAG or the SBA through Caprock. So the difference with that is your payment with any of the SPAG programs or the SBA, your rate is going to be fixed on those. Whereas a lot of times banks will have variable rates. It depends on how long your loan is. It might, the rate might shift every 5 years, every 3 years. It depends on the terms of your loan with the bank.
In some cases, we may be willing to go a max term of say 10 to 15 years, which affects your loan payment, of course. And then when you think about where prime and commercial rates are today, I mean, we would look. I mean, you're looking at, anybody know what prime is currently? 8.5%. Right? 8.5%. We always look to make a spread over prime. So if you're talking about the 2% spread even on top of prime, you're looking at 10.5% today, right? So we're really hoping rates being that high don't benefit us really. If people aren't borrowing money, that doesn't really benefit us. So we would actually prefer that rates do come down, and it's looking like rates are going to start coming down into the next year. So, but 10.5%, they can. I mean, they're almost 5. What'd you say?
5.7.
5.7. I mean, so you think about if you can utilize a program like theirs and cut that rate almost in half, and actually get a fixed term over a longer period of time. I mean, it's a great benefit, great alternative to what we can offer sometimes at a conventional loan.
So that split of the percentages you showed earlier is like 50, 40, 10. So in this case, we would start with a loan, the bank, and you would loan 40% of what we borrowed?
No, so I would start with the total project cost. Let's say you're going to go buy a piece of land and a building for $1 million. That's an easy one, right? Then $500,000 of it is the overall project is what we're looking at. So 50% of it, $500,000 of it's through the bank with their rate and terms. 40%, $400,000 of it is through the SBA through Caprock, fixed for 20 or 25 years, and then you're going to inject 10%. Yeah. That's an easy one to look at. But I would start with total project cost. And that's a good point too. We do get calls sometimes, and I'm sure Kraig gets these as well. Like, well, how much could I borrow? Well, don't start there. Start with what do you need and have those estimates. And you be thinking about your own cash flow. You kind of got an example of how you can put that together. So.